Welcome back, everyone. Today is the second day of practice to pass session, and I'm Syed Amjad Hussain. I'm teaching SBR and SCAN School and College of Accountancy, Rawalpindi campus. And yesterday we have gone through the overview of SBR syllabus, how the examiner is going to test, the knowledge you have gained during the study of your SBR course syllabus, and how the knowledge would be testable in different section of your exam paper, and what are the main ideas, what are the main requirements when you're looking into your exam pattern, and what you should consider while answering your question within the practical exam scenario. Along with that, as this is the first session for computer-based exams, so we have gone through the CBE environment, computer-based examination environment, a platform which gives you an idea how the examination would be held and how the examiner is going to test you within your exam. So we have looked into all those aspects. If anyone has any question with respect to the yesterday topics, so do let me know. I'll be answering your question. If no, then we are going to start our today's session, which is day 2, and today we'll be looking into the question number 1 of your question paper, which is related to the consolidated financial statements, specifically IFRS 10, 11, IFRS 3, IAS 28, and IFRS 12. So all of these 5 standards are more or less bit related to consolidated financial statements. So we'll be looking into all of these 5 standards today. So anyone has question with respect to the yesterday topic, I'll be glad to answer this. COVID-19 related issues, the impact of COVID-19 on accounting. I think that yes, there is an impact, and there are multiple topics, multiple discussions available which are explicitly saying how this COVID-19 has actually impacted the financial statement of the organizations. But as far as main concern, main idea is that everything is going to smoothen down once again, and business environment is opening up. So most of the businesses have created losses, but with the revival of the economy, with the with like restitution of all the business activities, the businesses are going to be profitable once again. So mainly I would recommend that if there is any impact of IAS COVID-19 specifically, that could be an indicator of impairment for certain assets, but might not be. They could be possible that certain businesses grow very faster compared to other businesses. Certain businesses go downsides, specifically in airline industry has got a very huge impact on its business activities. So right now, I don't have any plan to go through this impact of COVID-19. IFRS 16 leases, yes, and IAS 36. Every standard might have an impact of COVID-19, it depending upon the situation or the scenario that was provided by the examiner. So it's all dependent upon your understanding, right? So this is something, it could be possible, but there are, if I have multiple questions I've seen over here. So exactly, that comes. Sorry, someone has sent the question that there is a rent concession provided by the landlord or the lessor, so it has an impact on IFRS 16. Yes, I hope everyone of you have looked into IFRS 16 modification of lease terms and conditions, and those modifications are actually part of those requirements. So it's not something there is a new standard available. It's something that there is a guideline already available within the standard. You need to apply that guideline with respect to COVID-19 situation, right? So I don't think there is a specific guideline for COVID-19 within the accounting standard. Examiner might ask you a situation which could be accounted for within the existing standard. It will give you a guidance. The existing standard have given you a guidance how this idea should be accounted for. For example, there is someone who has sent me a question. Uh, there are multiple questions, so let's look into one by one question. With respect to COVID-19, IAS 16 subsequent adjustment or subsequent amendments to the lease agreement should be accounted for. Like I hope you or everyone you have studied, if there is a lease payment, if there is a lease payment which is depending upon the you can say indexed rate. So the lease payment should be accounted for or should be reassessed year over year, and that directly impact the lease obligation. And second thing is that is the right to use asset, and onward you are supposed to account for the changes you have made. So COVID-19 impact, if there is a lease curtailment within the lease term, then you have to account for it as an amendment to the lease contract. Second, there is another question someone asked about the security guards. We have last day we have discussed about the dogs, those are purchased or those are acquired by a security company, and the dogs were actually acquired with an intention to help the guards to fulfill their duties. So in that case, initially you are going to record those dogs under IAS 16, and later on that should be accounted for under the model of either a cost model or a revaluation model. That is, subsequently you have to depreciate those dogs based on an estimated useful life of those dogs, and if there is any residual value, obviously you need to account those for. I hope I have answered that question. Your recording is available, I believe, and most probably ACCA will guide you how you can looking into the yesterday's webinar. We have some worksheet. Okay, if you are supposed to provide calculation within the Excel sheet and you are making some sort of your calculation aspect within the Word, sorry, the other part of your answer, that is the discursive portion. Calculation portion is basically done on Excel sheet, and discursive portion most probably done on should be done on Word sheet. So if you want to like link the calculation within your answer, you can go back and through to the Excel and Word sheet, or you can show those sheets alongside to make sure that you are answering your question. But as far as examination or the reviewer is concerned, or the person who is looking into your examination, who is giving you marks, he'll be looking into your answer with respect to the caption you have provided at the top of your answer, to which specific section this answer relates to, that we have discussed yesterday. So examiner is comfortable in looking into the answer in the way you have mentioned. But as far as your answer is concerned, I would recommend that for calculation perspective, you should be using the Excel sheet, and for discursive question or descriptive answers, or for the discussion part of your answer, you should be using the Word sheet rather the Excel sheet. That's more appropriate for everyone. So the linkage, if you need to create a linkage, so you can go back and forth to Excel and Word sheet, or you can open Excel and Word sheet side by side on your computer screen, so you do both of these two sheets are visible to you, and you can answer your questions on that sheet. Any further question with respect to that? If no, then I'll be moving to the So there is another question which is related to the acquisition of a subsidiary, and there is an inherent share-based payment scheme operated by investee. How should we account for such? That is something we'll be looking into this aspect later. First, we'll be looking into question. I believe I don't think so. I have a question right now. COVID-19 does have an impact on the businesses. This is something everyone has an understanding, and obviously, if something is impacting the business, it must have an impact on accounting treatment. Right now, I have not seen any article related to COVID-19, but surely I'll be looking into this specific aspect in our last session, because I have already in my mind about the COVID-19 section and how that's actually impacted the accounting standards, but I have not planned it for today's class. So if there is any question related to COVID-19, that would be discussed on day 5, most probably, right? If we have ended our session, if we got some other issues related to this earlier, then might be I'm going to discuss that one. But right now we are looking into the consolidated financial statement with respect to the exactly that. So that if I believe there are multiple options and multiple answers to from most of you attendees, that most of the entities have faced credit loss because of the COVID-19. Exactly, they have actually, and for that matter, they might have rescheduled their loan facilities, and it might have impact on the financial asset they have, any entity has acquired. So impairment on financial asset must have an impact on it. So all of these things, or all of these aspects, will be looking into this specific section. The COVID-19 will be looking into this section later on. Right. So moving back to consolidated question, because this is something how to pass the exam paper. So we're going to start this question. So the first question in our exam session is a consolidation related question, and I have added one question within our today's discussion, that is December 2018 attempt question. So how you're going to answer your question, that's something we need to understand, and we need to make sure that any answer we have made, or any answer we are going to deliver for the examination, what the examiner has provided us. So we need to consider few of the basic criteria, few of the basic ideas based on which, or the focus areas, we need to make sure how you're going to account for these specific with respect to a specific question. So the very first requirement, whenever you're looking into a question, into your exam question, you must have to understand what examiner has expected from a student. What is the expectation of an examiner? What he wants to know about what was done by the students. Second thing that you need to consider is you have to understand the scoring scheme the examiner has given at the end of each requirement, right? And the third thing is you have to understand the main areas of the scenario based on the scores provided within the question. You need to understand what are the main section of my scenarios to which I have to focus on, and to make sure that that I have given the most importance to those specific areas rather to the scenario overall. The fourth thing is you have to make sure, you have to make your mind, you have to develop an idea in your mind that how you're going to develop your answer in order to secure the maximum marks within the question. The fifth one is where I need to create the link between the different requirements provided within the question, and then you need to attempt your question. But before this, within the 15 minutes time span that is provided to you as a reading time pattern, as a reading time for to every student to read out the question. So I would recommend, if you have spent like more than 15 minutes on reading out your paper, that's far more better, rather haphazardly looking into the question and then answering it right away. What do you think? I believe it's far more important for every student to read out the questions carefully, to think about all these aspects what I have mentioned within this requirement, and then you are going to answer your question. So whenever we are looking into every question, we'll be having the same idea, the same theme, and the same thought process that how we are going to answer our question with respect to what the examiner has provided to us. So you guys have already the handouts available with you. So right now I'm just going to open up this question. Right now this question is basically related to December 2018 attempt. There is a background. I'm going to read out this background and then we'll be looking into the main requirements. The following are the extracts from the consolidated financial statements of Moise Group. Group statement of profit and loss account for the year ended 30th September 2000 X8 is given below. So this is something you have provided with a profit and loss account, group profit and loss account, or a consolidated statement of profit and loss account, statement of comprehensive income, and you are also provided with few of the extracts from the group statement of financial position. So these are the extracts that are provided to you and you need to account for with this aspect. So I'm not reading out these, they are just three aspects. Even from these two main areas, I can have an idea that the examiner is going to ask me for something, a cash flow statements related to operating activities and nothing else as of now, the basic background of scenario. So in the next portion, I'm looking into the following information is also relevant for the year ended 30th September 2008. There is the first portion is the pension scheme. So whenever there is one section that's named as pension scheme, so you must be having in your mind that most probably this is something related to IAS 19 employee benefit standard. So yesterday I have also discussed with everyone that within the first question, you don't think about it that the examiner is just looking into IFRS 10, or examiner is just asking you question with respect to IFRS 10 or IAS 28 or IFRS 11, IFRS 3. No, the examiner can link any standard, any other standard within the consolidated section. So in this portion, examiner has tested IAS 19 employee benefits from the students, that how they are going to account for that, how the pension schemes should be accounted for if those are provided within the question. Next section is goodwill. This goodwill is related to IFRS 3, so it's pretty easy for us. I believe this adjustment is not something a very technical adjustment. Then not only this, the next requirement was related to IAS 16 property, plant and equipment. You can see here property, plant and equipment PPE at 30th September 2006 include cash additions of 134 million, depreciation charge during the year of 99 million, and impairment loss of 43 million was recognized. Prior to the impairment, the group had a balance on the revaluation surplus of 50 million, of which 20 million related to property, plant and equipment in the current year. So that's a main requirement for IAS 16 property, plant and equipment. And along with it, the examiner has also tested IAS 36 within the same requirement, right? Next is IAS 2 inventories. This is something inventory question was related here, but this section is specifically related to intra-group transaction within the group. If there is any sale or purchase, so how you are going to account it for. And not only this, there is also, I think, a foreign exchange data that was also tested for. So IAS 21 is also tested within the section. Goods were purchased from dinar 80 million cash when the exchange rate was $1, dinar 5. Moise had not managed to sell the goods at 30th September 2008, and the net realizable value was estimated to be dinar 60 million at 30th September. Okay, and value was estimated to be dinar 60 million 30 September. The exchange rate at the date was $1 equals dinar 6. The inventory have been correctly valued at 30th September 2008 with both exchange differences and impairment correctly included within the cost of sales. So this basic section is related to IAS 2 inventories. Along with it, IAS 21 foreign exchange were also accounted for within this section. Then changes in group structure. This is something, a change in group structure was also mentioned. So IFRS 10 was tested here. During the year ended 30th September 2008, Moyes acquired a 60% subsidiary, Devonport, and also sold all of its equity interest in Braham for cash. The consideration for Devonport constitutes of a share for share exchange, together with some cash payable in 2 years. 80% of the equity shares of Braham had been acquired several years ago, but Moyes had decided to sell as the performance of Braham had been poor for a number of years. Consequently, Braham had a substantial overdraft at the disposal date, and Braham was unable to pay any dividends during the financial year, but Devonport did not pay an interim dividend on 30th September 2008. So next is discontinued operation, that is IFRS 5, non-current asset held for sale and discontinued operation. So this is also tested here. The directors of Moyes wishes to advise as to whether the disposal of Braham should be related as a discontinued operation and separately disclosed within the consolidated statement of profit and loss account. There are several other subsidiaries which all produce similar products to Braham and operate in a similar geographical area. Additionally, Moyes hold a 52% equity interest in Watson. Watson has previously issued share options to other entities which are exercisable in the year ended 30th September 2009. It is highly likely that these options would be exercised, which would reduce Moyes' interest to 35%. The directors of Moyes require advice as to whether this loss of control would require Watson to be classified as held for sale and reclassified as discontinued operations. So this is the whole scenario, different scenarios provided within your exam section. Now, one more thing that we need to look into the requirement and the marks allocation scheme. So first thing is draft an explanatory note to the directors of Moyes, which should include a calculation of cash generated from operation using indirect method. So you are supposed to use a calculation of cash generations from operation using indirect method. Next is an explanation on specific adjustment required to the group profits before tax to calculate cash generated from operations. So you have two requirements actually. This first requirement is based on the calculation of how the cash generated from operations should be accounted for. The next requirement is you have to explain why those adjustments were made to the cash generated from operation section. So both of these two requirements, what I believe is it could be possible that 5 marks should be allocated to this section and most out of these 12 marks, right? There are total 12 scores assigned to the section A, the main A requirement. So I would believe that 5 marks would be assigned to this section and 7 marks should be assigned to this section. But we'll be looking into the examiner marks allocation scheme, which would be available to you once you are done with your exam section, and examiner might be giving you an idea how the scores were allocated against the calculation and the discussion part of your question. Next requirement was, so this basic requirement actually inculcates all the scenarios which are mentioned in the question. So you need to understand that you have to identify any non-cash items which is provided within any of the section of your above scenarios. Next is explain how the changes to the group structure and dividend would impact upon the consolidated statement of cash flows at 30th September 2006 from the Moyes Group. If there is any dividend provided by the Moyes, how that dividend given would have impacted the consolidated cash flows. So you need to have discussed your question, your discussion pattern. You have to explain these things. You should not attempt to alter your answer to part A. So you're not supposed to alter this section, right? So you only need to explain this. And if you are looking into the linkage between two, so you have to understand that the cash flows generated from operation, this is something an extension to that specific portion. So first you need to calculate this one. It's not directly linked with the section 1, because in this attempt B, in this requirement B, examiner has specifically asked you not to include, not to alter the answer in your requirement number A. So you need to only explain what you have done over here, how the dividend, if paid by Moyer's companies had impacted the cash flow statement. So you need to be very careful how those dividends should be impacted. Next, section C is, or the C requirement is, advise the director as to whether Watson should be classified as held for sale, and whether it means both Watson and Braham should be classified as discontinued operation. The both of these two subsidiaries, those were disposed of. If we can mention these two subsidiaries as discontinued operation or non-current asset or discontinued operation and classified as held for sale under IFRS 5 or not. So you have to understand what are the IFRS 5 requirements. There is one another section, D section, and that's something I've mentioned. This is related to the conceptual framework, right? So 2018 version of conceptual framework of financial reporting, the conceptual framework of International Accounting Standard Board, specifies that it must meet two fundamental qualitative characteristics. I don't think so that you might not have an idea. I believe everyone has an idea that recognition criteria for assets and liabilities have been changed by the conceptual framework, right? Now the conceptual framework believes that it's not the criteria of probability, which was mentioned by the earlier version of conceptual framework, that if it is probable that outflow or inflow of economic benefit arises towards an entity or out of the entity, outflows was from the entity, economic outflows are done from the entity in future. If it has a probable chances, then you have to record that as an asset or a liability, right? But now the recognition criteria have been changed. Now conceptual framework specifically mentioned that if the two fundamental qualitative criteria, one is relevance and the faithful representation, have been met, like if any asset, by disclosing or by recognizing any asset within the financial statement, give more faithful representation to the stakeholder or to the user of the financial statement, then you are supposed to provide that that asset. You have to recognize that asset within the financial statements, and if it provide more relevance data to the users of financial statement, then whatever the asset or liability is, so that asset or liability should be provided in financial statement, rather considering the probable inflow or outflow related to that asset or a liability, right? So that's the change done in 2018 conceptual framework. So current accounting standards have been criticized for not necessarily applying the recognition criterion relating to assets and liabilities on consistent basis. So that's one of the objection provided by many of the stakeholders, that framework has been changed, definition of assets and liabilities have been changed, but the recognition criteria mentioned in each and every standard has not been changed. The standard are saying the same recognition criteria going forward, and the criteria within the standards have not been changed as the conceptual framework has been changed. So you need to required in this case is explain how the new criterion has been applied consistently across accounting standards. So you need to make sure you have to explain how the change criteria was consistently applied across accounting standard. You need to illustrate your answer with reference to how there are inconsistencies with the measurement of intangible assets, provision, contingent consideration. You need to also explain how change in conceptual framework had impacted the existing accounting standard. And you can see here it's a 6-mark question. So in total you have 30 marks available. If you look into it, the marking scheme, so this is the marking scheme that was provided by the examiner. So calculation of cash flows generated from operation should be given as 6 marks. Explanation of adjustment and use of a scenario was also given a 6-mark number. So you have 12 in total for requirement A. For requirement B, you are given a 6 marks, 1 mark for purchase consideration, shares and deferred cash consideration. Second one is impact on consolidated statement of cash flows of a subsidiary acquisition including dividend, and subsidiary disposal was given with 2 marks question. That's a B requirement. Then section C was IFRS 5, definition of discontinued operation and application to the scenario. So that's something which is given with the 3 marks. Consideration of held for sale and application to the scenario will given with 1 mark, and consideration of loss of control and application to the scenario is given with 2 marks. So this is how the score allocation was done within the examination section. And D is inconsistencies, application of probability criterion, including examples. Number 3, and proposed changes to the criterion was also given with 3 scores. So in total, you are provided with the 6 scores in this section. So right now, if I'm moving to answer this question, before this, I just want to give you an overview of cash flow. So we'll be moving to the cash flow sections, how the cash flows would be impacted, or how we are going to account for the cash flows. So important thing is, you have already studied basic cash flows within your previous studies, that was financial reporting paper, and in SBR you'll be provided with consolidated cash flows. So as far as I'm giving you an idea, if there is a difference between two, I recommend there is no difference between basic cash flows and consolidated cash flows, right? Cash flows should always be created from, or should always be prepared from, the basic 2 financial statements. Once the income statement and balance sheet have been prepared, only then cash flow can be prepared. So once the consolidated statement of comprehensive income and consolidated statement of financial position was created by the accountants, only then our consolidated cash flows can be created, can be prepared. Before this, you cannot create it. So one important thing is, we need to consider what is the impact on consolidated cash flows. So 2 main differentiations between individual cash flows, what you have studied earlier, and consolidated cash flows is, you need to make sure in consolidated cash flows, what is the impact on consolidated cash flows if a subsidiary was purchased or sold during the year. That's one criteria. And we have seen in our exam section, the examiner has specifically asked you, what is the impact if a subsidiary was disposed of during the year from the group accounts, and how it has impacted the consolidated cash flow sections. And if you want me, I can give you an idea over here. This is change in group structure. You can see here, this is the change in group structure. When Moyos acquired a subsidiary, Davenport, and also sold equity interest in Braham for cash, right? So there's a change in group structure if the group has disposed of a subsidiary. There might have an impact on the consolidated cash flows. And if the company or if the group has acquired a subsidiary, that also has an impact. And how that impact should be accounted for, we'll be looking into the format I have mentioned here. And second thing is, the next important part is, and believe you me, I believe I have accounted for both of these two in our questions. I have another question in which we will be looking into how the impact of foreign exchange gain losses, but it's not specific to the cash flows, but we're looking into it, how the foreign exchange gain losses on consolidated cash flows should have impacted. But these are the 2 main differences between the individual cash flows and consolidated cash flows. So let's look into cash flow statements, how the cash flow statement should be prepared. So presentation and preparation of cash flows was very much explained in IAS 7, the cash flow statements standard. One important idea is, whenever you are studying any standard, whenever you are looking into accounting concepts, whenever you're looking into the conceptual framework, we always studied that accounting is based on accrual basis of accounting, right? But cash flow statement is the only statement within the statement of within the financial statement which was prepared on cash basis of accounting. So you need to be very careful whenever you are answering your question, that this is the only statement that is based on cash basis, right, rather on accrual basis of accounting. So we're going to account for it, how we will be impacting it. So there are 3 main sections which was provided by IAS 7, and it explains that there are 3 sections. Those are divided: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So these are the 3 main sections of your cash flows. Those were explained by IAS 7, that how these 3 sections should be accounted for. We'll be looking into the details of this section, but right now what I'm going to tell you is, if and only indirect method and direct method, there are 2 basic methods provided by IAS 7. So another thing that I'm going to explain to you is, there is an inconsistency within IAS 7. So IAS 7 has never mentioned that, irrespective, it's depending upon the discretion of the company that whether the company is going to use a direct method or an indirect method. So whatever method the company has provided should be looked into. If a company is using an indirect method for the preparation of cash flows and a company B is using a direct method, then there is still a problem of comparability. I hope you recall something from your framework. The framework has provided a criteria or characteristics, that is, the financial statement should be comparable. You might have looked into, there are two basic qualitative characteristics: fundamental qualitative characteristics and additional qualitative characteristics. So the additional qualitative characteristics, it was mentioned that the data provided by the company should be comparable. Comparable to whom? The framework mentioned comparable to the previous data reported by the company itself and with the rest of the industry. So if two companies are working within the same industry, within the same business sector, and the company is preparing, one company is preparing financial statement based on indirect method and other company is preparing the financial statement based on direct method, this financial statements or the cash flows is not comparable. So there is an inconsistency within IAS 7 right now. So that's something, whenever you are mentioning whenever the examiner is going to ask you to criticize about IAS 7, you can mention this criticism on IAS 7. But we're not here to look into the criticism on IAS 7 right now. We're looking into how cash flows should be prepared. I'm giving you an idea. So cash flows from operating activities, if you are looking into direct and indirect methods, so difference is only based on cash flows from operating activities. Rest, cash flows from investing activities, irrespective if you are preparing cash flows from investing activities under direct method or indirect method, both of these two remains the same. There is no difference between these two, right? Only difference between direct and indirect method is that you have to prepare cash flows from operating activities in a different way under both these two methods, direct and indirect method. So right now I am not expecting that examiner is going to ask you to use a direct method, but that's something my understanding. It's not something that you should ignore it altogether. The examiner, okay, fine, examiner is not asking me to apply direct method. Examiner can ask you. Examiner has all the authority and have all the rights to ask you how to prepare cash flows using a direct method. So it's not difficult one, it's easy one, but you should be very cautious about it when a direct method is used. Under direct method, you should only consider the cash flows, total cash inflows, and you have to deduct total cash outflows. That's the only difference. All the cash inflows given within the scenario you have to account for within this section, but you need to be very careful what cash receipts should be included. I'll be looking into this aspect later on. So a cash flows from indirect method should already started from net profit before tax, and you need to make certain adjustments. Those adjustments comes from, you can see here, I have mentioned over here the format of an income statement. So if this is the income statement, you have to start with profit before taxation, right? From this section, profit before taxation, and you need to move reverse within your income statement and adjust all those expenses and income which are non-cash in nature, right? So you can look into it. I have already adjusted those within this section. Net profit, depreciation, amortization, impairment, interest expense, allowances, income from associates, investment income, and gain on disposal of non-current assets. So all of these items are non-cash items. Just giving you an idea, if anyone has any confusion about it, if interest expense is either a cash or a non-cash expense, so I'll ask you guys to recall IFRS 9. Within IFRS 9, when you are charging interest expense, that interest expense should always be charged based on effective interest rate, right? That effective interest rate was calculated based on IRR model, but interest payment was always based on the nominal interest rate. And in most of the scenarios, nominal interest rate and effective interest rate are different. So the company has charged a different interest expense while the company has paid a different amount with respect to that interest payment. So that's always different. So I would say that interest expense is something different. Allowances is another way. Income from associate, IAS 21, if everyone is clear about it, you have to take the share of profit of associate and include that share of profit of associate within your consolidated financial statement, the consolidated income statement. But the associate has not delivered the cash against the income you have recognized in your income statement. Associate might have given you some sort of dividend, and that dividend was deducted, that dividend should be deducted from investment in associate from your balance sheet or statement of financial position. I hope you understand. So this is also a non-cash item. So once you have adjusted all the non-cash items till income statement, till this point, the gross profit, before the gross profit, right? So you have made all the adjustments. Once you've made all the adjustment, you need to be looking into these two items: revenue, cost of goods sold, and gross profit. I would say we're not going to make any adjustment using under indirect method with these three items, because these three items should automatically be accounted for when you're looking into the current asset section and current liability section, that is the working capital. I have completed this income statement within under my cash flow statements. Now I'm looking into the balance sheet, and I'll be moving back to my question once I'm done with this. I have few of the adjustments, and we'll be looking into those adjustments. Then we're jumping to our question, because we have understood the main idea of how we are going to answer the question. Second thing is your balance sheet. So as the cash flow was generated or prepared from balance sheet and income statement, so we are done with our income statement aspect, except only these three items. So once you are looking into the working capital section, that is the current assets and the current liabilities, so these changes should be made to the operating activities. You can see here, over here, this cash flows before working capital changes: increase, decrease in receivables, payables, and inventory. You have made this adjustment over here, right? And then you will be making further adjustment, that was interest paid and tax paid. And you can see here, I have made the adjustments, right? And then I'll be looking into current liabilities, and those current liabilities would also be adjusted in working capital changes, cash flows from operations. So this is, I have mentioned in abbreviation, so that it will not take a lot of space and we can easily understand. You have seen there are just two items left, that is under current liabilities it's bank overdraft, and under current assets it's cash and cash. So these should be accounted for under cash and cash equivalent. That was the last head of your cash flows. Second thing, you have to account for the taxes paid and interest paid, right? So interest paid and taxes paid should be accounted for if there is some interest provided, interest payable within your income statement balance sheet under the current liabilities head and taxes paid. You need to make sure, once you're finding out how you need to find out the taxes paid, this taxes paid should always consider the deferred tax and the current tax. That's really important to understand. If you remember IAS 12 deferred taxation or taxation standard, the current tax or the tax charged to the profit and loss account for the current year is based on three items. One was the current tax that was provided by the taxation authorities. Second was over and under provision that was based on the previous year estimates. And third thing is your deferred tax, which is based on the differentiation of the taxation rules and accounting rules. So you will be looking into the temporary differences, but that's something part of any other course. So once you are done with cash flows from operations, you need to be looking into cash flows from investing activities. So you have to make sure in your mind, investment means what? Investment means I have invested few of the cash into some other activity, and from where I want a return. So what is the section in your balance sheet that fulfills this basic requirement? And I believe that's a non-current asset section. You have invested some amounts within any other activity to get the return, to get the profits from that specific asset. So whenever you're looking into cash flows from investing activities, you should only be considering this non-current asset section of your balance sheet, right? So anything that comes under non-current asset section should always be accounted for under cash flows from investing activities, right? Except any item which was related to the day-to-day operation activities. If something is related to day-to-day operation, that should comes under the head of cash flows from operations. Last thing, that's the third section or third portion of your cash flow statement, which is named as cash flows from financing activities. What financing actually means? Financing means the business has gained funds from whom to get some benefit out of those to run its businesses. So I believe business has only two options available to get the finance from either from lenders, that is non-current liabilities, or from the shareholders. So these are the two main sections. One is the capital section and other one is this, the non-current liability section, that should be accounted for under cash flows from financing activities. Rest, this bank overdraft is should be accounted for under cash and cash equivalents, and you can see here this is the cash and cash equivalent item that should be accounted for: opening cash and cash equivalent, closing cash and cash equivalent. So this is how it should be accounted for. Now just giving you an idea, so cash and I'm not looking into cash and cash equivalent, I'm just looking into if you have acquired, if a subsidiary acquired or disposed of during the year, what you need to do is, first thing is, any cash received or paid for the acquisition of a subsidiary or from the disposal of subsidiary. If you have received the cash, if you have received cash by disposing of a subsidiary, I have an example. For example, if you have paid cash to acquire a subsidiary, so effectively you have lost control over this amount because you have delivered this cash to someone else. But once you have acquired a subsidiary, you have acquired a control on the cash which is retained within the subsidiary, right? So the net impact, the net loss of control on the cash is 80,000. You have lost control over 100,000 and you have gained the cash which you have gained the control with the acquisition of a subsidiary is 20,000, that is within the subsidiary, right? So you need to account for only the net impact of cash within your consolidated cash flows. That's something, the first idea whenever you have acquired a subsidiary. So you need to look into the net position of the cash impact. So if you have disposed of a subsidiary, so you'll be looking into cash received by disposing of a subsidiary. So you have effectively gained the control over 100,000. You have gained a control because if you have sold the subsidiary, you have received the cash and you have gained the control over an asset which is cash, which is 100,000. But once you are disposing of a subsidiary, so the outgoing subsidiary take the cash along with it, like this 20,000 cash that is within the subsidiary. So you have lost the control of 20,000 cash along with the loss of control on a subsidiary, right? So the net cash you have gained control over it, that's 80,000. It's the same case. So whenever you are looking into the cash provided, delivered for the acquisition of a subsidiary or cash received from disposing of a subsidiary, that should always be accounted for in a net position. Now I'm going back to give you a linkage between these two. This investment in subsidiary should be accounted for under non-current asset section, right? So non-current asset section, once we are looking into the format of IEA of cash flows, we have identified that non-current asset section should be accounted for under cash flows from investing activities, right? So this cash paid for the acquisition of subsidiary or cash received by disposing of a subsidiary, this 80,000 should be accounted for under cash received or paid or cash under your cash flows from investing activities. I hope it's pretty much clear to everyone how this should be accounted for, and we're going to relate it to our question into that question. Next is, if you have acquired a subsidiary during a year, if you have acquired a subsidiary during the year, every item in a balance sheet must be adjusted for as a result of sale of a subsidiary or acquisition of a subsidiary. So to give you an easy understanding, if you have acquired a subsidiary or if you have disposed of a subsidiary, so you have to change the opening or the closing balances of every account within that slide. For example, if non-current assets net book value of a group, net non-current assets of a group have a net book value of 1,50,000, right? And you have made an accumulated, you have charged an accumulated depreciation or depreciation of 20,000 to the financial statements of the current year. So 20,000 accumulated depreciation, and you have disposed of. I have this scenario available. During the year, a subsidiary was disposed of whose non-current assets of 10,000 were in the opening balances, while these were disposed of during the year and are no more in the balance sheet at the reporting date. Within this opening balances, as the subsidiary was disposed of during the year, so within these opening balances, this 10,000 should be available, but within this closing balances, this 10,000 is not available. So you need to make sure either you can update your closing balances or you can reduce your opening balances. But I would recommend, if the subsidiary was disposed of, then you have to consider it like disposal of your non-current assets, right? As the subsidiary was disposed of, this non-current asset was disposed of along with the subsidiary disposal, but you have not received any cash for the disposal of this non-current asset. You should be considering it as an adjustment in your non-current asset section. So that's how you need to account for if you have sold out a non-current asset. Sorry, if you have sold out a subsidiary, the non-current asset should be adjusted accordingly within that section, right? Next, I believe the next section is exchange gain losses. Exchange gain losses should be accounted for in the same way. Each item of gain or loss should be accounted for as increase or decrease in specific element of financial statement. Whenever there is a foreign exchange gain or loss, I believe everyone has an understanding how foreign exchange gain losses should be accounted for within the group accounting statement. So if there is a foreign exchange gain or a loss, for example, if there is a foreign exchange gain on non-current asset, then the non-current asset value, the closing balance of the non-current asset value had been increased, but this was not increased due to additional cash payments. This was just increased due to what? Due to the foreign exchange reserve, which is a non-cash item. So if there is a non-cash item, we have to exclude it. So we can add that foreign exchange gains within the non-current assets of non-current assets T account, so to make sure that this was adjusted. So this is how you need to account for. Now coming back to our question, how we can account for, so apologies, so I'll be opening up another Excel sheet on which we'll be working. So first thing comes first is, what was the first requirement? Within the question, the examiner has asked you to calculate cash flows generated from operation using indirect method. You have to calculate the cash flows which you have using indirect method from this. So the starting point for the cash flows would be what? We need to make sure that that should be the profit before tax. If there is profit before tax given in the question, yes, we have profit before tax. That's the value of 209. So cash flows from operations. Cash flows from operations start with profit before tax. I'm mentioning it, profit before tax. So that's value is 209, as we have just seen into it. Now, someone has asked me how we can account it for. So you can use these two tables side by side. I'm going to look into these two sections side by side. So within exam section, you'll be provided the Excel and the PDF file in the same pattern. So I'll be going to zoom it out to make sure it's 100%. So this is something we have right now, and we'll be looking into these while scrolling it back and forth to understand how it actually works. So that's something within the exam, you'll be provided with this PDF file, which was pretty much clear to you, and it adjusted itself within that section of your balance sheet. So I hope it's visible to everyone. If it's not visible, do let me know. I believe it's visible now. It should be visible to everyone. It's pretty much clear. Next thing that comes into that you should consider is, as we have mentioned, profit before tax. This profit before tax, I have told you that we need to move up in the income statement to make sure if there is any adjustment till this gross profit point, any adjustment which is a non-cash item, we have to account it for. And the only thing is share of profit from associate. So we need to adjust it back. We need to adjust share of profit from associate, which is 27. As this is the profit, and this profit is actually a non-cash item, and this non-cash item has actually increased the profit before tax. So I'm going to reduce it with the value of 67 minus 67. So I have deducted, right? Because the profit was already increased. Now there is no other item left, within this operating expenses section. So what we need to do is, we need to make sure we'll be moving into the notes, we're moving into the disclosure notes, those are provided, because that item, this balance sheet item, should comes once you have done with all of the changes those were done within this operating expenses. So first things come first, the pension scheme. IAS 19, I hope everyone has a knowledge of IAS 19 and how this IAS 19 actually works. You have to make sure there are like few of the items those were available in IAS 19. Just looking into the brief section of IAS 19. This is employee benefits, IAS 19, and I'll be giving you a format. So these are the few of the items those were reported in your IAS 19. First one is the net pension plan obligation. This net pension plan obligation always increase with component, net interest component, right? And this net interest this net interest component is always charged to profit and loss account. But do you think it is something that you have paid for the pension plan? No. Second is the service cost component, which includes both the current service cost component, the previous past service cost component, which includes curtailment, increase, and settlements. And both of these two items are based on accrual basis of accounting, not on a cash basis of accounting. The only thing that you need to make sure is contribution paid within the plan by the company. That's only the cash item you have paid along all of these items. Next is the benefit paid. I hope if you have studied IAS 19, you might be aware of it. Benefit paid is something you have pension plan assets and you have pension plan liabilities. The pension plan scheme or the pension plan assets, once the obligation was due, you are going to pay from those pension plan assets for the pension plan liabilities. So in that case, if you're looking into the net pension plan obligation, this net pension plan obligation, if the pension plan obligation has decreased, why? Because you have paid for those pension plan obligations from the pension plan assets. So if both assets and liabilities have reduced, so there is no impact on net pension plan. So it has no impact on your cash flows if some benefits are paid for the pension plan obligation out of those pension plan assets. So this has no impact on our cash flows. Last thing is the remeasurement component, and you always know this remeasurement component is actually balancing figure that should be accounted for. So this remeasurement component has no impact. Now we'll be moving back to our question, because we have identified how this IAS 19 standard actually works. Now if you're looking into it, Moyos operate a defined benefit scheme. A service cost component of 24 million has been included within the operating expenses. A service cost component. Do you think this, as we know, this is an operating expense and that is charged to the profit and loss account, but is it a cash flow item? No, it's not a cash flow item. So I'm going to adjust it back. A service cost component, like I would say pension plan cost or pension plan expenses. Your pension expenses, you can say it employee expenses or pension. I'm naming it as employee expenses, and I would name it as related to pension, right? So that examiner could understand what I actually mean. So I'm going to adjust it 24 million because this is an expense that have already reduced this profit from tax. So I'm going to add it back to increase the profit once again. The remeasurement component for the year ended was a gain of 3 million. The remeasurement component created a gain of 3 million. So do we need to adjust it? No, we don't need. Why? Because the starting point in our cash flow is profit before tax, while this remeasurement component was adjusted in other comprehensive income. So we have not accounted for the other comprehensive income. Why we're going to account for this item? So we were going to ignore this one. So whenever looking into exam, you can like cross this one. Next thing is benefit paid out of the scheme was 31 million. Do you think this is something that you need to account it for? I have already mentioned that this benefit paid was from the pension plan assets. This will reduce the pension plan asset, and the pension plan assets were maintained by some insurance company or a financial institution. So it's none of our business that irrespective whatever the benefit was paid, that was paid by that financial institution, an insurance company or a bank or whatever the organization is there, right? So this is not concerned to us. Contribution into the scheme by Moyes, the Moyes group has paid 15 million. So this is the cash flow that was paid, and as this is related to the employee expenses, so it's cash flow from operation that should be accounted for. So contribution in plan was 15 million. So I'm going to deduct this 15, right? So we have done with this one section. I hope everyone is clear how we're going to account it for. Don't hassle your answer, or don't get hesitated, and don't get all the information summed up together. You need to count for one by one. You need to look into each and every aspect of your answer one by one. Once you are done with one requirement, then move on. Because if I want to secure the marks, I need to make sure I am understanding the basic aspect. I'm looking into what was mentioned within the question, and I'm going to answer that specific aspect of a question. Rather, I'm going to answer all together at once. I'll be looking into, because this section has some scores allotted to it, and I believe, I'm not sure how many scores, but we have seen it that how many adjustments are there. I believe there are like 5-7 adjustment, and for this specific adjustment I think there should be 1.5 marks given to these two adjustments what were made to this cash flow statements. Next is goodwill. So goodwill impairment is something that is always a non-cash item. You have reviewed the financial assets or the goodwill of a business, if that asset was impaired or not. So you find out that the goodwill of the company was reduced. So you have charged this impairment to profit and loss account, which is a non-cash item. So we're going to reverse it. So impairment of goodwill should be reversed, because it's a non-cash item, and as it is an expense and it is already reduced, oh sorry, it's 10 million, it has already reduced the profit, so I'm going to increase it back, right? Next is your property, plant and equipment. Now in this property, plant and equipment section, you need to make sure what is charged to profit and loss account with respect to this property, plant and equipment. The first thing is property, plant and equipment at 30th September include cash addition of 134 million. You have spent cash of 134 million to acquire new non-current assets. But what do you think? This 134 million could be accounted for under cash flows from operating activities? No, it's an investing activity. So you're not going to account it for this specific section. We'll be moving on. This depreciation charge during the year was the depreciation charge during the year was 99 million. So this depreciation should be charged to this profit before tax, and this profit before tax was reduced. So we're going to reverse this depreciation charge, right? So I'm going to reverse this 99 million, as with this expense, this depreciation charge, the profit was reduced. I'm going to increase it back. An impairment loss of 43 million was recognized in this year. How much of the impairment you have charged to the profit and loss account? And this impairment charge of 43 million, but this is always charged during the year. right? Depreciation charge during the year of 99 million, and impairment loss of 43 million was recognized. So you have recognized a 43 million impairment charge in this case, right? Prior to the impairment, you need to make it prior to the impairment, the group balance on the revaluation surplus was 50 million, of which 20 million related to property, plant and equipment impairment in the current year. So what do you think what was done? This is something in this section, not only IAS 16 cost model was tested. In this case, the examiners also tested the revaluation model. Under the revaluation model, if there is an impairment related to revalued asset, so what you are going to do for revalued asset, you should be making sure that okay, fine, leave it. So if there is an impairment related to a revalued asset, you have to charge impairment to revaluation first and then to profit and loss account, P&L account, profit and loss account, or you can say it's statement of comprehensive income. So in this case, total impairment was charged with a value of 43 million. Out of this 43 million, there is already a revaluation surplus of 40 million available within the revaluation surplus account. Out of this 40 million, 20 million is related to this 43 million impairment, right? So how much of the impairment should be charged? You can say this total impairment was divided into, so separated into or divided into, one is your revaluation, right? And second one is your profit and loss account, or I would say it's other comprehensive income and profit and loss account, right? It's 20 million is related to other comprehensive income. How much is related to profit and loss account? I'm going to deduct it, so it's 23 million. So only 23 million of the impairment was charged to profit and loss account. So in this case, this 23 million should be reversed. I'm going to reverse impairment, because impairment expense, right? Impairment expense related to non-current assets was reversed with the value of only 23 million. As this is an expense and that had already reduced the profit and loss, so I have reversed it. I hope there should be no problem till this calculation. Now, another thing, another portion of our question is your inventory, and this is, by the way, a complicated aspect, and you need to be very, very careful when you're looking into the impairment of an inventory. Goods were purchased for dinar 80 million of cash. When the exchange rate was $1 to $5, Moyos had not managed to sell the goods at 30th September 2008. Right? And the net realizable value was estimated to be dinar 60 million by 30th September. The exchange rate for this date was $1 to $6. The inventory has been correctly valued at 30th September 2008 with both the exchange differences and impairment correctly included within the cost of sales. So there are two things: exchange differences and the impairment. So examiner has confused you guys how you're going to account for this impairment. I'm going to make another, this is your you can perform this working within the Excel sheet, or you can perform it somewhere else. So you can say it's something workings. I'm naming it as working. So I have to make sure this is working one. It's working one. I'm just making it working one. Now I'm looking into working number two. So what is working number two? Working number two is related to inventory. You can name the above as well, so that examiner would, it would be easier for examiner to understand what you have done. So it's related to non-current assets. I'm just labeling this working one. So I'm labeling the working two as inventory. So I just give you a overview of IS 21. Now, what IS 21 actually relates to, just giving you an idea how IS 21, I believe if will be so. IS 21 basically is related to three basic terminologies. First one is the functional currency. Three basic aspects IS 21 actually is concerned with three basic aspects. One is the functional currency and the presentation currency. You need to understand what is the functional currency of a company and what is the presentation currency, and how functional and presentation currency should be accounted for, right? Second is your individual foreign transaction made by within individual customer by the companies. That's something the IS 21 actually relates to. The third one aspect with which the IS 21 mainly is focused is the foreign operations. Foreign operation include that was basically a foreign subsidiary, associates, a joint venture, or some other operations. So how you're going to account for the foreign operations or the individual foreign transaction that you mentioned. I'm just looking into, because as far as our question is concerned right now, we should be looking into this individual transaction rather into the foreign operation. So this is not the foreign operation. So right now I'm just going to give you an idea how the individual transaction should be accounted for. Individual transaction, if you're looking into it, IS 21 explained there are two types of transaction. One is a settled transaction and the other one is unsettled transaction. If there is a settled transaction, it must be translated on the date of transaction dates with the spot rate or with the spot rate which was available. Spot rate is a rate that could be an historical rate, or that could be the current rate. For example, if I've acquired the inventory on some date, that's the spot rate of that date, and I have to translate the inventory on that specific date, and then I'm going to sold that inventory within the to any foreign customer. So that's another date, and I'm going to use that specific spot rate to translate my sales. So purchases and sales should be translated or based on the exchange rate available on the date of the transaction. That's the spot rate. Average rate is something which is average of two or more spot rates. Or you can say there is another limitation or a criticism on IS 21 was IS 21 does not provide you a guideline how to calculate the average rate. So every company, every accountant can use his own idea how to calculate the exchange rate. The accountant might use an opening rate and a closing rate of the year, and he can divide it two to calculate the average rate. Or another accountant who can use every quarter end exchange rate divided by 4 to find out an average. So that's another thing which I just want to give you an idea that how the criticism actually work, and you need to understand once you are looking into the standard to find out what was the main idea. Second thing is unsettled transaction. In our case, in this scenario, we have seen that this is an unsettled transaction. Why unsettled transaction? Because we have purchased the goods, but we are not able to, or the Moyes group had not managed to sell these goods. These goods are still within the inventory of Moyes company, right? The Moyes group. So this was an unsettled transaction. If the inventory was purchased and it was sold out during the year, so it was a settled transaction. But right now it's not a settled transaction, so we need to make sure this is an unsettled transaction. If it is an unsettled transaction, you need to make sure unsettled transaction should be differentiated between monetary and non-monetary items. I believe I have. Unsettled transaction, you need to identify two things: whether the item under consideration is a monetary item or a non-monetary item, right? If it is a monetary item, you have to retranslate that item at the reporting date, and if it is a non-monetary item, then you're not supposed to retranslate it once again, right? But in this case, if I'm looking into it, inventory is always a non-monetary item. If anyone has a problem with respect to okay, someone has asked, give me a second. contribution in the plan, contribution in a plan. Someone has asked me IS, and let me complete this one, and then I'll be going back, just looking into IS 21, and we're looking into inventory adjustment, and then I'll be coming back to your questions. If I missed any one question, do let me know, I'll be answering it again. But right now I'm looking into IS 21. So we have monetary items and non-monetary items. Monetary items, if anyone has confusion, I'm going to explain it. What is the meaning of monetary items? Monetary item means it is an item which can be basically allocated with the specific units of currency. And most of the students, I got an understanding, they have confusion between monetary and non-monetary items. So non-monetary item is an item to which we cannot assign a specific units of currency. Example includes, monetary items includes loan, receivables, payables, cash, and many other like this. Once you're looking into non-monetary items includes property, plant and equipment, inventories, and buildings, and the land, and any other item that should be accounted for in this way, to which you cannot assign a specific units of currency. If someone has confusion, I have a bit of explanation here. I believe I have here, and if I got that one, then I'm going to explain that to you. So that's the explanation for if you have a problem with monetary and non-monetary. This is something I have explained it. So I have mentioned exact unit of currency. For example, I have mentioned here over here a loan, right? And I have named land as a non-monetary item. To make an understanding, most of the students told me that Amjad, if we have a loan, then the value of loan would be changed with the interest amount. I would say, yes, I agree. The loan value would be changed with the interest you're going to charge, right? But if we are considering that we have a land of 100,000, principal amount is 100,000, and we have a loan with a principal amount of 100,000, same. We have purchased a land for 100,000 and we have acquired a loan of 100,000. Both of these two things are same. We have purchased a loan note which was issued by some other individual, and he's paying me the interest, which was my interest income, and I have acquired a land of the same value, 100,000. I have rented it out to some tenant who is giving me a rent on monthly basis. Suppose interest is 10,000 on this loan note, 100,000 loan note. In the same way, rent on that property was 10,000, and the value of the building would remain same. Now, if we're going to exclude this rent and this interest, it means that both the earning elements of the assets were disconnected from the asset, right? Now, if someone is going to ask me, or if someone can tell me whether the loan value is going to change other than this interest, it's never gonna possible. This loan value will remain same. It's 100,000 for year 1, it's 100,000 for year 2, and it's 100,000 for year 3. If 10,000 was the interest that was charged, and you are paying the 10,000, in the same way you have land element which cost you 100,000 and the rent was 110,000, and that rent was paid on monthly basis or on annual basis, right? So there is nothing other element that's going to change this loan value, right? But if you look into the principal market value of land, its value is going to change. In the year 1 it's 100,000, in year 2 it might be 200,000, in year 3 it might be 3,50,000. It's never gonna stick together. You cannot assign an exact unit of currency, but because the land value is appreciating day by day. As far as loan is concerned, its value can never appreciate, right? So over here, if you have understood the monetary and non-monetary item differentiation, I'll be moving back to IS 21, where we have discussed identify things as a monetary item and non-monetary item. Now we have understood that inventory is a non-monetary item, but if there is an impairment on inventory, what we can do, that there is another concern. You would be given a scenario in your textbooks that if you have a building, a non-monetary item, which is a which is situated in some other country, and you cannot assign the value to that specific non-monetary item within your functional currency. It should be reported in a foreign currency, right? So you have to revalue that asset, and if there is any revaluation, how you can account it for the revaluation and the foreign exchange gain on that foreign non-current asset should be treated as a revaluation surplus, rather separating the foreign exchange gain losses and the revaluation surplus. In the same way, if you are going to look into the inventory is also a non-monetary asset, right? And if you are going to charge an imp, because IS2 said that inventory should always be recorded, initially it should be recorded at cost and subsequently it should be recorded at lower of cost or NRV. So if the NRV, net realizable value of that inventory, was reduced, right, then you have to charge an impairment to profit and loss account. And if it's a foreign inventory, and you cannot assign a value to that inventory within your functional currency, you have to retranslate that inventory within the within your functional currency, and if there is any impairment, you have to record it. Now, one more thing I missed over here, or I skipped, is what is the importance of your functional currency and presentation currency. So functional currency identification is far more important. Why? Because every transaction which was made in any other currency than the functional currency should be translated first into the functional currency, and then it could be recorded in your books of accounts. Before translating any transaction which was not done in the functional currency of the company should be first translated within the functional currency using the spot rates, and then it can be recorded in your books of accounts. I hope you understand this functional currency concept. Now we'll be looking into how this inventory should be accounted for. So when you have purchased this inventory, you have purchased this inventory on Moyes had not managed to sell. So when the inventory was purchased, suppose it's purchase date, as the date was not mentioned, so I'm going to purchase date of this inventory. On this date, you have purchased an inventory of $80 million. Suppose if it's $80 million, so $1 equals 5 dinars. So how many dollars it become? As the dollar is smaller and dinar is higher number, so as a result, if we are going to translate these dinars into dollars, then we must get a lower value. So I'm going to divide it with 5. So it's $16 million. I'm going to convert these dollars, right, into, these dinars into dollars. So I have converted on purchase date. What about on the reporting date? Value of this reporting date, value of this inventory. So it has mentioned that net realizable, you can see here, the company has purchased these goods or these inventories for 80 million dinars, that equals $16 million, right? But Moyes was not able to, had not managed to sell the goods at 30th September 2008, and the net realizable value is estimated to be dinar 60 million. So if it's a 60 million dinars, you can say, right, in this case it's a 60 million dinars, but what was the exchange rate over here? The exchange rate was $1 equal to 6 dinars. So the value of this inventory at reporting date would be 10 million. So any difference, any reduction in the inventory value should be reported as impairment, right? So how much is the reduction? The reduction value is this value minus this 10. So 6 million is the impairment that should be reported on inventory. I hope everyone get the point why I am not differentiating between the foreign exchange gain losses and the impairment charge, because it's a non-monetary item, right? And I have to charge any foreign exchange gain losses along with the impairment to the profit and loss account. So I'm not going to bifurcate between the foreign exchange gain losses and the impairment loss on this inventory value, right? So that's not the point. So any amount that is the decrease in value of inventory should be charged directly to profit and loss account. And we have seen here that impairment is $6 million, and that impairment was charged to profit and loss account. I'm going to reverse that impairment, right? So I'm going to reverse this impairment over here. And what was the value of impairment of inventory? Expense, impairment expense that's related to, right, that's related to inventory. How much the value is? Loss on inventory or impairment of inventory was $6 million. So as this was charged to profit and loss, I'm going to reverse it, right? So I have made this adjustment. Now looking into changes in group structure. So this is the next point where we're going to mention it, but before this, these two adjustments, I'll be looking at your question, and I'll be looking if someone has any concern. So I'll be asking. I'll be explaining it. Sure, I'll be going out for a break for 15 to 20 minutes. So just give me 5-10 minutes. I'll be going through your question, and then I'll be going out for a break. So what is I hope I have answered the question, why are not we bifurcating exchange loss and impairment of an inventory? Because it's a non-monetary item, and IS 21 explicitly refused, because we are not going to retranslate non-monetary items on the reporting date. But to calculate the impairment, it's something required for us. It's something required for us to retranslate it, because without retranslating, we won't get an idea what is the value of that inventory on the reporting date, right? If you get the point or not. If there is still confusion, do let me know. But because IS 21 strictly prohibits non-monetary items should never be retranslated. In this case, as the net realizable value of inventory was provided in the foreign currency, it's not in the functional currency, it's in foreign currency. What is foreign currency? Any currency which is not the functional currency of the company is a foreign currency. So as the value of that inventory was provided in foreign currency, we have to have translated into our functional currency to find out if there is if the value of the inventory remains same or it has changed, right? But as the inventory value might have reduced due to impairment, some of the value of inventory was reduced due to the impairment loss, and few of the inventory value was reduced due to the foreign exchange loss. So we are not going to bifurcate these two. We should be reporting as a club amount within the profit and loss account as impairment, because IS 21 disallow retranslation of any non-monetary item. I hope it's pretty much clear. So non-current asset held for sale, accrued expenses and period expenses in the balance sheet of a group. So non-current asset held for sale and accrued expenses and prepaid expenses, and prepaid expenses, if they are related, then they should be treated as operating expenses, because those expenses are related to operations. So you need to understand whether these expenses are related to operations or to something else. If this is related to operation, then it should be accounted for under operating activities. I hope I have answered how do we bifurcate impairment loss or exchange loss. We're not going to bifurcate the impairment loss or exchange loss in any way, because this is not allowed by IS 21. If you have a question related to this one, that inventory value, IS2 inventory values should be over here in working 2. We are supposed to apply IS2 inventory. So inventory should always be recorded lower of cost or NRV in subsequent measurement, right? In this case, if I'll be looking into this requirement, so this is the NRV that was provided, right? So the cost was 16 million in functional currency, and at reporting date, We have seen that NRE was reduced to 10 million. So we have to record the inventory at 10 million rather at 16 million. So if you're going to reduce the value of the inventory by 6 million, so inventory should be credited and impairment loss to profit and loss account should be debited. That should be charged to profit and loss account to make sure that that was charged to that year's income statement. Benefit paid into the pension. Okay, there's one more question. Instead of inventory, if we have a monetary item, then we will separate foreign exchange losses and impairment. Yes, we need to. If there is a monetary item, you need to differentiate between the foreign exchange loss and the impairment loss if it is a monetary item, most probably in the case of IFRS 9 financial instruments. Benefits paid into the pension plan. Benefit paid, there are many questions. So benefit paid within the pension plan. Now I'm just going to give you a clarification about this. Benefit paid within the pension plan relates to what amount. It's something I have already explained it, but once again I'm going to show you why these benefit paid should not be included. It's IAS 19. So you have seen here, this benefit paid is something, it's paid out of these pension plan assets. This is the opening balance of your pension plan, this net pension plan obligation. This is the result of these two. It's a future obligation. You are paying for the pension plan. Suppose I would say, I'm just giving you an example. We have on 1st January, on 1st of January, I have a pension plan obligation of 100,000, right? Along with it, the fair value of pension plan assets, the company, Moyes companies had invested within the pension plan assets because the company don't wait for it. Why wait for it? That if the pension plan obligation was due, then I'm going to pay it to the employees. It's not possible because sometimes the pension plan obligation was way higher. The company might not be able to pay all the pension to the employees. There are many employees, those got retired, those get their jobs done with the company and they are claiming the pension. So to overcome this situation, company on ongoing basis invest few of the amounts into the pension plan of its employees, right? And it's the responsibility of that financial institution, either a bank or an insurance company or any investment company that's going to maintain your plan. So you have taken out few of the cash and paid to that financial institution so that they can purchase few of the pension plan assets. Those will meet your future obligation. So fair value of your pension plan obligation would be suppose 90,000, right? So the net obligation, the net pension plan obligation would be what? The net pension plan obligation would be this 10,000 minus this 90,000. You have an obligation. The company has an obligation of 10,000, right? If there is a benefit paid by the company to the employees, so it's not the company who's paying the benefit to the employees, it's the pension plan assets which is paying to the employees. Suppose the pension plan has paid an amount of 5,000 to the employees for the pension of the today's year, so for the current year. So it means the fair value of pension plan asset should reduce by 5,000. And as the pension plan asset had paid a 5,000 obligation, the obligation must have to reduce by 5,000 again. So the net impact would be, what is the impact? Sorry, apologies, just give me a second. I need to move it over here. So this is the payment, and we can see here the closing balance. So what is the closing balance after this payment? Your pension plan asset, your pension plan obligation would be 95,000 and your pension plan assets would be 85,000. So what is the net impact right now? You have an obligation of 10,000 once again. So there is no change in the obligation of the company due to the benefit paid by the pension plan fund. I hope it's clear. Someone has told me that before before going to the changes, group structure changes always impact your working capital along with your what should I say, along with your cash flows from operations. Sorry, cash flows from investing activities. That's impact both of these two. Okay, we're going to have 15 to 20 minutes breaks because this session got very long, and I always take a break after an hour. But this is a question, so it's not something I got a break. So we have 25 minutes break. After 25 minutes, we'll be joining back, and we'll be completing up this question to make sure we're also looking at the discussion part of this question, which is more important rather than just calculation part. We have to look into the discussion part, and as I have already discussed all the standards, we have to add up these standards within our discussion session, right? All of these standards what we have mentioned should be part of our discussion session. So descriptive part should be added up in the same way what we are actually making in our discussion over here. Okay, we'll be joining after 25 minutes, a 25-minute break, right? Okay. Welcome back, everyone. Apologies. I think I'm just 5 minutes late further. So we have already discussed about the pension plan contributions. I hope that's pretty much clear. Why did we not consider the benefits paid out? I hope I have answered the question, but if still there is a confusion, then do let me know. I'll be explaining it once again. But as of now, we are done with almost all the parts. Someone has asked me a question how we have calculated this impairment on non-current assets. So the total impairment charged is 43 million on non-current assets. Out of this 43 million, 20 million is related to the revaluation surplus that was already created, right? So if some amount that was charged or an asset which is already revalued and there is an impairment charge to a revalued asset, first the impairment is charged to the revaluation surplus before charging this impairment to profit and loss account. So if there is any additional impairment, more than the revaluation surplus on a specific asset, only that impairment should be charged to profit and loss account. So in this case, if total of 43 million of impairment is charged to, or it was recognized on a specific non-current asset, out of this 43 million, 20 million was charged to other comprehensive income, that is to the revaluation surplus account. So the remaining of 23 million is only charged to profit and loss account. I hope this is also clear, and this should be clear to those who asked the question. I'm moving to the next topic, which is the group account, right? And we'll be making it sure before this group account we are done with the changes in cash flow or cash flows before working capital changes. Cash flows before working capital changes. This cash flows before working capital equals, I believe, 289. So this is the cash flows before working capital changes. Once the cash flows before working capital changes have been calculated, you need to make sure if any changes made to the working capital section. Working capital section should include current assets and current liabilities portion, which was provided in your question. So you have inventories, as there is an decrease in inventories year over year. So decrease in inventories should be added up because you have freed up few of the cash that was actually tied up within the inventory. So how much cash is tied up? Actually 165 million was the opening balance of inventory and the closing balance is 126 million, right? So in total 39 million of the cash flows is actually released from the inventories account. But in this case, if you can account for this impairment as well, this is also a decrease in value of inventory which is not related to the cash release tied up in inventory. So we have to exclude this as well. This is not a increase in cash flow. This decrease was basically due to impairment, rather the decrease in value of inventory. If you are going to understand it using a T account, so I'm going to give you an understanding how this T account actually works. So I'm going to create a T account over here. So to give you an understanding how this T account actually works, so I'm going to merge. So this is inventory account, right? Inventory account, a T account of inventory. Inventory has an opening balance of 165 million, I believe 165 million, while the closing balance of inventory was 125 million, right? So the difference between these two is this value minus this value. So it's around 40 million. I believe it's not 40 million, 126 million. It's not 125, it's 126 million. So this is the total decrease in inventory value, but out of this decrease, there is another decrease due to the impairment. We can name it as impairment of inventory. This was the cash released from it. So we need to minus another value from it, the 6 million. So the total cash released due to lower release due to lowering the inventory levels was just 33 million. So this is the cash that was totally released out of the inventories that you have managed it. So this is 33 million that should be accounted for. Over here we have accounted it for. Next is your receivables. So receivables is pretty simple calculation. Your receivables have been increased. Receivables have been increased with the value of 149 minus 156 million, right? So you have tied up another 7 million of cash within the receivables, or you have given for, or you can, if you want to understand and increase the receivable, you can consider it that you have delivered another 7 million of cash to your customers, right? You have delivered your further cash, so that's another cash element. Next thing is your uh, increase in payables. So increase in payable was something 215 minus 197 million. You have actually received cash, another amount of 18 million of cash from your suppliers. So you have not paid those suppliers yet. So the total value of cash balances in this case would be this total, that was 333 cash flows from operations. Why we are considering this cash flows from operations before charging any tax and interest, as we don't have any information related to tax and interest, so we cannot calculate exactly what is the total value of cash generated from operations. Up to the information provided in the question, this is the cash flows from operation we have actually accounted for, right? So we have answered the requirement one. You need to explain all these workings. How you can explain it? You need to explain share of profit from associate, why this share of profit from associate was deducted from profit before tax. You need to explain it. If you will be looking into the answer I have mentioned over here. So this is the second portion, sorry, this is the second portion of your answer. This is the calculation of what we have done. I believe calculation might be done in some different perspective in the Excel sheet that I've made, but it results into the same value that we have calculated, this $333 value. So cash flows from operating activities are principally derived from the key trading activities of an entity. So you need to be very careful. It's key trading activities. This would include cash received from sale of goods, cash payment to suppliers, cash payment on behalf of employees. The indirect method adjusts profit or loss for the effects of transaction of non-cash nature. We have already discussed any non-cash nature transaction should be reversed, right? Any deferred accruals from the past and future operating receipts or payments of any items of income and expense associated with investing or financing cash flows should be reversed. So this cash is actually related. This cash is actually related to the investing portion or investing activities of your business rather from operating activities. The cash related with the associate. The share of profit of associate is an item of income associated with investing activities, hence so being deducted, right? You can see one by one every item was explained with line by line. Likewise, cash paid to acquire property, plant and equipment is an investing cash flows rather than an operating one, so we have not included it altogether in it. Non-cash flows which was reduced profit must subsequently be added back, including the service cost component, depreciation, exchange losses and impairments. With an impairment of property, plant and equipment, the first 20 million of impairment will be allocated to the revaluation surplus. Only 23 million would have been reduced operating profits. That's profit and loss account we have already discussed in our study, and should be added back. In relation to the pension scheme, the remeasurement component can be ignored, as it is neither a cash flow nor an expense to the operating profits, to the profit and loss account. The remeasurement component should always be charged to other comprehensive income rather to profit and loss account, hence it will always be ignored. Next thing is cash contribution should be deducted, though, as this represents an operating cash payment ultimately to be received by MOI's employees. Benefit paid are a cash outflow from the pension schemes rather than the MOIs, and so should be ignored. We have already discussed with the standards. So whenever you are making sure, I have already discussed in the previous session, in the yesterday session, that Within the consolidated section, you cannot consider yourself that examiner is going to ask you to adjust or to make adjustment based on operating cash flow or based on the consolidated adjustments. Examiner can test any standard within the consolidation section to make sure that the examiner has a vast room available with him to test the knowledge of your accounting standard within any part of your examination, because this examination is basically based on your understanding about the standard. So if you look into the explanation, you have you have you have to create a link. What this explanation means, I have told you earlier that this explanation is just like the notes you are going to add, the disclosure notes you are going to add to the financial statement, the fifth financial statement, which is notes to the financial statement. So in this paper, examiners try to make sure that you are prepared well about how you are disclosing the information you have updated in your financial statement. This is the cash flow statement, and these are the disclosure notes you are preparing for those cash flow statements, right? So this is how you would be explaining your answer, but this is always based on the standard. In any of your answer, we'll be never looking into it that examiner is asking you to add some other explanation. Examiner is always asking you to add an explanation based on your understanding about the International Accounting Standard Board, International Accounting Standards provided by International Accounting Standard Board, and the framework you're provided with, right? Along with it, you need to provide some interpretation of the data provided to you within your exam. So this is something we're done with. Cash contribution should be deducted, though, as these operating cash flows and benefit paid is a cash flow from the pension scheme rather than MOYOs, so it should be ignored. The movements on receivables and payables and inventory are adjusted so that the timing differences between when cash is paid or received when the items are accrued in the financial statements are accounted for. Inventory is measured at lower of cost or NRV. We have already discussed. The inventory has suffered an overall loss of 0.6 million. 80 million dinars divided by 5 minus 60 million divided by 6. Of this, 2.7 million is an exchange loss and 3.7 is an impairment loss, right? Neither of those are cash flows and should be added back to the profit and loss account. So that's something, if you are looking into the impairment loss, you can find out, but in this case it's not differentiated between exchange loss and the impairment loss, because non-monetary items should never be translated but again and again in this case. So total value should be charged as an impairment loss to the profit and loss account. Hence, the loss of 6 million should be adjusted in the movement of inventory as a non-cash flow. The net effect of the statement of cash flow will be nil. So once its impairment expense was added back, right, and one again it was deducted in decrease in inventory, so the net impact is always zero. Cash flows from operations, this net impact was always zero, but examiner, you need to show the examiner that you have understood the adjustment. If you're going to miss, or you're going to miss this 6 million, suppose I'm going to delete this one and again I'm going to remove the decrease in inventory with the 6 million, the result is always the same, it's 333 million, right? Ultimate impact of this adjustment is always zero, but you have to show the examiner that you have understood the concept. Impairment expense of inventory you have understood, and this decrease in inventory levels was actually accounted for. So if examiner has asked you cash flows, what was the cash flows before working capital changes, that always has an impact of this impairment expense on the inventory. I hope this is pretty much clear to everyone, and we'll be looking into the next requirement of our question, which was explanation. We have done any working can either be shown in a main body or explanation notes. Explain how changes to the group structure and dividend would impact upon the consolidated statement of cash flows at 30th September 2008 for the Moyes Group. You should not attempt to alter your answer to part A. You're not supposed to alter this question, but you have to explain it. What is the impact of change in group structure? So we're looking into what are the changes that we have made to the change in group structure. So this is change in group structure. Changes in group structure, I believe there are two more companies. During the year ended 30th September 2008, Moyes acquired 60% of the subsidiary. If a 60% subsidiary is acquired, then Within the opening balances of consolidated balance sheet, all the assets and liabilities don't include the assets and liabilities of Devonport within the balance sheet. Why? Because this subsidiary was no more in the during the in the opening balances. Why? Because this subsidiary was acquired during the year 30th September 2008. Hence, closing balance should include the assets and liabilities of this subsidiary. How we can account it for? We need to add the opening balances or the balances of assets and liabilities of Devonport opening balance at acquisition date. The balances of all the assets and liabilities of Devonport at acquisition date should be added in the opening balances of the group financial statement. So we need to account it for how much amount should be included. Secondly, if you look into it, within the cash flows from investing activities, you should be deducting the cash outflow. That cash outflow is actually based on the total amount you have paid for the acquisition of subsidiary less any cash balance of Devonport at acquisition date should be reduced. So the net impact should be reported in your cash flows from investing activities via acquisition of a subsidiary as having a label of acquisition from subsidiary. But this should never be accounted for within the cash flows from operating activities. That should always come under the heading of cash flows from investing activities. So that's the main idea you should be considering it. The equity of 80% of the equity being acquired several years ago, but Moise decided to sell. There is another company. So that's something we have updated the Devonport. Devonport, along with this, not only this, along with this, the dividend, if you have received any dividend, I think the dividend was also mentioned here, how expense structure. So first we will be answering the change in group structure, and then we're looking into the impact of dividend upon the consolidated statement of cash flows. What is the impact of dividend on consolidated cash flows? We are done with the acquisition of Devonport, how we are going to account for the acquisition of Devonport during the year. Second thing is the consideration paid consists of share exchange and with some cash. So yes, there is another thing. You have exchanged the shares. What do you think? Do you have paid the cash for Braham for cash? Devonport and also sold an equity shares in Braham for cash. So right now we are not looking into this sold subsidiary, we are looking into the acquired subsidiary. The consideration of Devonport consists of a share for share exchange and some cash payable in 2 years. Right now in this year, have you paid any cash for the acquisition of Devonport? You have paid no cash, right? So with the acquisition of subsidiary, you only need to deduct the value of cash you have acquired control with the acquisition of a control of Devonport, right? So that don't shows any of the cash inflows, while sorry, no, it's not going to show any cash outflows. It might be showing a cash inflow figure with the acquisition of subsidiary, right? But as you have exchanged the shares, so the share capital has been increased, right? And we are going to account for the increase in share capital and equity section and the non-current liability section within the financing activities, cash flows from financing activities section of our cash flow statement. So any new shares issued, have you received any cash? We have not received any cash, rather we have acquired, we have attained the control of Devonport. Hence, increasing shares, increase in the value of share capital or a share premium account has no impact on the cash flows. So we must consider this, that neither your cash flows from financing activities will have been impacted with this change, right? And there is another increase within your payables. You have a contingent consideration right now that you need to, also it's a deferred consideration. So you have a deferred consideration that should be paid within the 2 years. So you have recorded the deferred consideration. You have to calculate the present value of the deferred consideration based on the risk factor or the cost of capital of the company, and you have to do unwinding of discount on that deferred consideration. With that deferred consideration, the liabilities have been increased, but that liability don't have any impact on your cash flows from operating activities or cash flows from investing or financing activities. Along with it, you might have charged some interest to the profit and loss account, right, based on the present value of the deferred consideration and the you can say in the cost of capital. So that interest even don't have any impact on your cash flows, so even that interest should not be deducted from cash flows from operation activities, so that should be excluded. This is another consideration, that you're looking into this specific aspect which was mentioned, the deferred consideration. If you are not mentioning these 2 points, examiner is not going to give you the answer, because the examiner has specifically given you 2 options. Examiner must have told you that we have not paid any cash for the acquisition of Davenport. We have actually issued shares and committed to pay some cash which is payable in 2 years. We have not paid any cash within the year, right? So 80% shares of the Braham. Now we're looking into the disposal of subsidiary. If you have received cash for the disposal of Braham, a subsidiary, an 80% interest in a subsidiary, you have disposed of that subsidiary. 80% of the equity shares of Braham had been acquired several years ago, but Moyes had decided to sell as the performance of Braham had been poor for a number of years. The company has not performed well, the subsidiary has not performed well, so you have sold it out. Consequently, Braham, as the company's performance was poor, Braham had a substantially overdraft at the disposal date. The Braham company had overdraft within its books of accounts. So the net figure would be, suppose I'm just giving you an example here. You have received cash for disposal of Braham, which equals 100 million, and you have to net off the cash, the control of the cash you have lost. In this case, there is no cash balance available. There is an overdraft facility which you have lost a liability. You are not supposed to pay this overdraft anymore because you don't have the subsidiary under your control. So you need to add this. Suppose it's 10 million, so you have to add it. The total value that should be reported in cash flows from investing activities would be sale proceed of a subsidiary was 110 million. You need to explain it in your words within your exam section. We'll be looking into the answer right now, but we are now creating our answer, how we need to look into the total aspect of our scenario. So I'm taking up, or I'm snatching the words from the scenario to make up my answer. Rather, I'm developing my own something, right? So you need to be very careful how you're going to develop your answer. It's actually based on the standards. It's nothing based on something you need to generate it. It's something you have already studied the standards, you have already gone through the standard, you have a knowledge of standards, and now apologies sorry, you need to apply those standards to that specific scenario. And I'm doing the same thing. I'm not doing anything else. I'm just picking up the words from the scenario and making sure that I am explaining the standard, what standards say for that specific situation. Next thing is, Braham was unable to pay any dividend during the financial year, but Davenport did pay an interim dividend on 30th September 2008. Now, one more thing, examiner has specifically told you that you're not supposed to change, you're not supposed to amend or modify your standard, you're not supposed to modify your workings in your section A, right? So we'll be looking into it, why we're not changing it. In this case, as Braham was unable to pay any dividend, so if there is any dividend, that dividend income should be reported in your cash flows from either from operations. But as you are working on consolidated financial statement, if it's an individual financial statement, then any dividend received from either Braham or Davenport, that should be accounted for as an income from a subsidiary income from investments, or investment income. You'll be looking into that investment. But if you are looking into the consolidated financial statements, you have to eliminate any dividend you have received from a subsidiary. So in this case, there is no dividend income reported in this profit before tax. You cannot amend it. You have not received any dividend either from Devonport or from Ram, but as no dividend from received from Ram, so there is no change within the financial statement, within the cash flow statements with respect to Braham, the company you have disposed of. But as Devonport has paid you the dividend within the year, that dividend should be reported under income from investing activities, and you have to report that amount you have received within your group financial statements, group or the consolidated financial statement. But ultimately, if I'm saying it, sorry, in individual financial statement, that should be reported in your income from associates, so income from yeah, or cash received from subsidiary or an investment. But in consolidated financial statement, as the parent or a subsidiary has declared the dividend, that dividend was the cash paid out by the subsidiary, and that cash was ultimately received by the parent company. So the cash balance, parent plus subsidiary, you have added up in your consolidated balance sheet. So there is no impact on your cash receipts, and along with it, your retained earning, irrespective either is parent or subsidiary, that was increased. So the impact of the dividend paid by the subsidiary was only on the NCI working. It has no impact in consolidated cash flows on the parent company. Are you getting the point? You should be comparing what is done within the individual financial statement and what we are going to do in consolidated financial statement. As we have eliminated any dividend income received from the subsidiary during consolidation process, right? So only the 80% of the dividend paid by the subsidiary company, that is Devonport. I believe we have 80% investment in Devon, or 60%. 60% of the dividend that was paid by the Devonport should have no impact on your cash flows. But the 40% of dividend must have reduced the NCI value, the non-controlling interest value, and that should be reported in your cash flows from financing activities. Because if you're looking into the equity section, non-controlling interest should always be reported in the equity section, and we have already discussed that equity section and non-current liability section should be reported in cash flows from financing activities. So any decrease in your non-controlling interest for which you have paid the cash actually should be accounted for under cash flows from financing activities rather than investing activities, right? So that's how it has impacted your cash flows. We'll be looking into answer, we'll be studying it, how the examiner has answered it and how the examiner has developed that answer. So this is something when the parent companies acquire or sell a subsidiary during the financial year, cash flows arising from the acquisition or disposal are presented within the investing activities, and we have understood the same thing. In relation to Devonport, no cash consideration have been paid during the current year, since the consideration consisted of a share for share exchange and some deferred cash. So the deferred cash should be presented as a negative cash flow within the investing activities, but only when paid in 2 years time. Right now it should not be accounted for. This does not mean that there would be no impact in the current year statement of cash flows. On the gaining control, Moyos would consolidate 100% of the assets and liabilities of Devonport, which would presumably increase some cash and cash equivalent at the date of acquisition, right? The cash of the subsidiary. So these would be presented as a cash inflow at the date of acquisition, net of any overdraft held at acquisition. I believe Devonport might not have an overdraft, but you have to explain it. If there is an overdraft, that should be accounted for, because if you're looking into the format of our cash and cash flows, cash and cash equivalents, we find out that cash balances and overdraft balances should always be treated as cash and cash equivalent balances. Adjustments would also need to be made to the opening balances of assets and liabilities by adding the fair values of the identifiable net assets at the acquisition date to the respective balances. This would be necessary to ensure that only the cash flows effects are reported in consolidated statement of cash flows, rather total assets rather the increase in assets due to the acquisition of subsidiary. Fair values adjustment to the assets and liabilities could also have a deferred tax effect. So yes, that's something we have missed, right? So when you are increasing the fair value of an asset, that must have a deferred tax effect. So that tax should also have to be adjusted for, and the cash payments for tax included within the statement of cash flows should be included when you are including updating cash flows from operating activities. So you have to adjust the tax payment within the cash flows from operating activities. So if there is any deferred tax impact due to the fair value adjustment, that should also be accounted for. Dividend received by the MOEs from Devonport are not included in consolidated statement of cash flows, since cash has in effect been transferred from one group member to another group member. So once, if you're looking into individual cash flows, that must have an impact, but once you're looking into consolidated cash flows, that has no impact, because the cash paid by the subsidiaries was ultimately received by the parent company. And when you are consolidating up, you are adding up parent cash plus the subsidiaries cash. So if the subsidiary had paid a cash amount and that was received by the parent company, so the 60% cash has no impact. Only 40% of the cash that was paid to the non-controlling interest, which is not part of the group, that should be adjusted, but that should be adjusted from cash flows from financing activities. I hope this answer is a sample answer, right? So if you have missed one item, like we have missed this deferred tax, I'm not asking you guys, I'm not asking or advising anyone to miss some point and expect the examiner not to deduct the scores. The examiner is going to deduct it, but I would recommend within SBR syllabus, no answer is 100% correct and no answer is 100% incorrect. As far as you are justifying your answer, based on international accounting standards, based on IFRS recommendation, your answer is correct. Two individuals sitting in the same exam of SBR and giving a different opinion on a same scenario based on their understanding in the application of the standard, what they understand, it's 100% correct. For example, if examiner has given me a question on which he has provided me with the investment property, and he told me, and the examiner asked me how I'm going to account for the investment property within my books of accounts. So I'm assuming it that investment property should be carried at cost model. So I'm giving him an explanation how the cost model on investment properties actually works. While another student or another individual who considered that investment property should be carried at fair value, so he is answering his question based on the fair value measurement. Both of the answers of those two individuals is correct as far as you are applying the IFRS in a correct manner. Are you getting the point? If you are not explaining the IFRS in the correct manner only, then it's not something that's giving you the good scores, if or the examiner is going to deduct your scores, right? Okay, next thing is another thing that we have missed. On the disposal of Braham, the net assets at the disposal date, including goodwill, are removed from consolidated financial statements. Since Braham is overdrawn, there will have a positive cash flow effect of the group. The overdraft will be added to the proceeds less any cash and cash equivalent at the disposal date, if there is any, to give an overall inflow presented in investing activities. Care would once again be necessary to ensure that all balances at the disposal date are removed from the corresponding assets and liabilities, so that only cash flows are recorded within the consolidated statement of cash flow. So that's the main idea of IFRS 10 when you are applying it. This question is purely related to IFRS. This section is question number 1. Section B is purely based on the application of IFRS 10. Purely this specific section. These 6 marks, I believe these are 6 marks. Yes. No, these 6 marks. Yes, these 6 marks are purely for the application of IFRS 10. In this, examiner has not tested any other standard. right? Next is advise the director on as to whether Watson should classify it as Watson, a company that was held for sale, I believe, whether both held for sale or whether both it and Braham would be classified as discontinued operation. So discontinued operation, we have this section as well. The directors of Moyos wish to advise as to whether disposal of Braham should be treated as a discontinued operation, the above subsidiary that was already disposed of, if that should be treated as a discontinued operation and separately disclosed within the consolidated statement of profit and loss account. There are several other subsidiaries which all produce similar products to Braham to operate in a similar geographical area. Additionally, Moyos hold a 52% equity interest in Watson. Watson has previously issued share option to other entities which are exercisable in the year ending 30th September 2009. So this Watson has a different scenario. Watson is a subsidiary in which Moyes company has a 52% equity interest. Watson previously issued some share options to some of the individuals. I hope all of you have an understanding of IFRS 2 share-based payments or share options that is given to the employees who can acquire that share options. And if the employees have acquired the share to other entities, to employees or to the other entities, if those entities have exercised their option in the year ending 30th September 2009, the next year, it is highly likely that these options would be exercised, which would reduce Moyo's interest to 35%. So it's no more a subsidiary of Moyes company, but it should be treated as an associate because you have lost the control over the subsidiary. The director of Moyes required advice as to whether the loss of control would require Watson to be classified as held for sale and reclassified as discontinued operation. So for both of these two subsidiaries, whether these should be accounted for as either discontinued operation or not. So before looking into the specific criteria that we are going to classify these two subsidiaries as discontinued operation, we need to make sure we have an understanding of IFRS 5. What IFRS 5 say about any operations that should be placed as a discontinued operation. So I'm moving to IFRS 5, where we need to get a basic understanding of how any item should be accounted for under IFRS 5. So this is IFRS 5. The main objective of this standard is accounting for non-current asset and cash generating unit for which management had intended to recover. You need to make sure what was the criteria. The objective of this standard is to make sure if any non-current asset or a cash generating unit, a group of assets that has a capability of managing its own cash flows, cash inflows and cash outflows. It's generating its own cash flows and it's meeting its own cash outflows expectation without depending upon any other department of the organization. For example, in the subsidiary, the Braham company and the other Watson company, both of these two companies are independent units. They are managing their own cash flows. They are not depending upon the parent for meeting their cash outflows, and they are not depending upon the parent company to help them out for the cash inflows. So these two, both Watson and Braham, should be considered as cash generating units in this case. So what is the recognition criteria? So there are certain conditions, those were defined by IFRS 5. One thing, non-asset or disposal group is available for sale in its current condition. You don't plan to modify any non-current asset before disposal, or you want to improve the discontinued operation or a disposal group before disposal. You have placed both the disposal group and the discontinued operation with an intention that this should be disposed of in its present condition. Second is, you have planned it that you're going to dispose this off and the sale is highly probable within the next 12 months. And how you need to make sure how you're going to account for it that the sale is highly probable. There are three main criteria for this surety of the probability. One thing is management is committed to do the plan, to do the sale plan, to management is committed to the sale plan. The management of the company is committed. They are not going to withdraw this sale plan. They are actively looking for a buyer, and the price was reasonably charged. If these three conditions are met, only then you can consider that the sale is highly probable. If management, suppose I'm considering it, if management is committed for a sale plan and management is actively looking for a buyer, but the price charged by the manager was way high compared to the market value of this non-current asset or a disposal group, then do you think the sale is probable, highly probable in 12 months? It's never gonna possible. No one is going to pay you a higher value than the market value of that specific item. So that's not meeting the probable criteria. Last thing is, management is not pursuing any other plan whether the assets or a disposal group can be used. Management is not looking into any other plan, what they are going to carry out. So in this case, I'm not going to look at, I'm not considering it. The rest of the criteria is how initial and subsequent measurement of IFRS 5 or a non-current asset or a cash generating unit should be applied. But in this case, as examiner has only asked us, in this case only asked us, so I have told you, you need to be considering what was the actual requirement. You need to advise whether this should be classified as held for sale or not. That's the only criteria. Examiner has never asked you, has not asked you in this specific requirement that if it is held for, if it is considered as discontinued operation, how we are going to account it for. So that's not the requirement of this scenario. So we are only looking into these basic criteria. So you need to start your answer with an understanding that whether this should be considered as a discontinued operation or not. So in this specific question, you should be asking yourself with respect to Braham, if you find anything within the scenario, within the situation provided by the examiner, if this could be meeting the conditions I have mentioned within the conditions, those are mentioned in IFRS 5. So if I'm looking into it, Moyos, the Braham company, from the last scenario, I find out that the Braham company was acquired several years ago, but as the performance of Braham company was not as expected by the company, so that's why it could be possible that Moyes companies might have considered this company to dispose of before disposing it off, because it's not performing as per the expectation of the parent company. So it is possible, if the three criteria we have mentioned, you need to start your answer with IFRS 5 explanation, right? The requirements we have mentioned, and then you are going to evaluate it. First, Braham, either Braham is meeting those expectations. As far as the scenario is concerned, I think that the Braham company, for the Braham company, these conditions might be met because the performance of the company was not good, and it is possible that the Moyes company management might have considered all those criteria, those were mentioned in IFRS 5, before disposing it off, because from this scenario it's clearly visible that management must have a plan to dispose of Braham company. This sale was not out of sudden. This sale was because of the poor performance of the company from number of years. So Moyes company's management might have looked into the aspect if they can improve the performance of a company or not. As the performance of company was not improved from many years, hence directors might have planned to dispose of Braham companies from last many years, and the disposal was and if the conditions was met, and if the management has an expectation, management has a true plan which is not provided within the scenario, so we can consider, so we can place Braham company as discontinued operation and can report it, the results of Braham company as separately in consolidated income statement and consolidated balance sheet, the assets and liabilities of that specific company. Next thing is your Watson company. For Watson company, do you think those criteria were met? Company has never thought of placing or disposing of that subsidiary. The control of the subsidiary was lost because the Watson company has already issued some share option to other entities, and when those entities are going to exercise those share options, the control on Watson companies was lost. In this situation, I don't find out any scenario where Moyo's management has any plan to dispose of this Watson company. They are not going to dispose it off. That was actually the loss. The control was lost because of the new shares issued by Watson, rather the disposal of this subsidiary by the Moyo's company. So as far as Watson is concerned, it's clearly visible from the situation that it can never be placed as a discontinued operation under IFRS 5 by Moyo's company. So you have explained it and you have mentioned all the aspects. So looking into the answer, I'm going to read out that answer, answer C. I believe that's answer C. This is the answer C. We'll be just going through this answer very quickly, and then we'll be winding it up, and I'll be looking into the next requirement, which is very important, the framework criteria. IFRS 5 non-current asset, sorry, non-current asset held for sale and discontinued operation defines a discontinued operation as a component of entity which was either being disposed of or classified as held for sale and represents a separate major line of business or a geographical area of operation that we have already discussed, is a single coordinated plan, and there is a single coordinated plan to dispose of separate major line of business operations, and is a subsidiary or acquired exclusively for sale. So this is something, this has defined what discontinued operation actually means to the actually means under IFRS 5. This is the explanation of discontinued operation over here. The examiner has explained. Next is both entities would be component of Moyo's group since their operations and cash flows are clearly distinguishable for the reporting purposes. Braham had been sold during the year, but there appears to be other subsidiaries which operate in a similar geographical region and produce similar products. Little guidance is given as to what would constitute a separate major line of business or geographical area of the operation. The definition is subjective, and the directors should consider factors such as materiality and relevance before determining whether Braham should be presented as corporation or not. To be classified as held for sale, to be highly probable the entity should be available for sale in its present condition, IFRS 5 requirement. At a face value, Watson would not appear to meet this definition as no sale transaction is going to take place. You are losing the control of Watson company because of the increase in share. IFRS 5 does not explicitly extend the requirement for held for sale in situation where the control is lost. It's not mentioned within IFRS 5. However, the International Accounting Standard Board have confirmed that the instances where control is lost, the subsidiary and liabilities to be recognized. Loss of control is a significant economic event and fundamental changes in investor relationship. Therefore, situation where the parent is committed to lose control should trigger the reclassification as held for sale. Whether this should extend to the situation where the control is lost or otherwise cause would be judgmental. It is also possible that therefore Watson should be classified held for sale, but to be classified as discontinued operation, Watson would need to be represent a separate line of business or a geographical area. In this situation, examiner has provided two different answers to the situation. We have only considered the one aspect when we are answering to the question that this is not mentioned within IFRS 5 and this is not going to take place with a single sale criteria, and as IFRS 5 has not mentioned any situation within its standard body, so we are going to place Watson on the basis of losing a control as discontinued operation or a separate cash generating unit that would be disposed of. But as far as the framework is concerned, as the control of the subsidiary was changed, so now over here the framework guidelines comes in, and as the framework tells when there is a change in the control or there is a major change within the control of a subsidiary, then you have to consider that subsidiary as discontinued operation. But before this, you need to make sure that Watson must represent a separate line of business as a geographical separate line of business or geographical area or separate operation entity for the group. Only then you can place this specific Watson company as a discontinued operation. So that's something, another idea was given by the examiner. So that's a good idea for us, that we have to include framework as well within the question when we are answering that specific question. Last requirement was related to the framework guidelines, and this framework guideline we have already discussed, and I'm going to reading out once again the main requirement body of that that framework requirement. And this is the scenario that was provided by the examiner, and the examiner is going to has asked you how the new criterion have been applied consistently across accounting standard. Illustrate your answer with reference to how there may be inconsistencies with the measurement of intangible assets, provision, and contingent consideration. Also explain how to change in conceptual framework impact the existing standards. The change you have made to the conceptual framework, the asset definition of assets and liabilities, the recognition criteria measurement that was changed, how it has impacted the existing standards. So I'm just going to, because we have left with just 3 minutes, I'm just quickly going through the answer to make sure that we're not involved in detailed discussion. That's the answer I have mentioned. It's basically, oh sorry, it's another question that we'll be looking into it tomorrow. This is a detailed answer. Actually, I have updated, because this is not an examiner answer. This is something I have updated, and you need to make sure what was the main answer. So this is different accounting standards using different levels of probabilities, and we always know that the criteria of recognition provided by most of the accounting standard was there must be 3 recognition criteria. Those must be met. One or 2 basic criteria. One is the cost of the asset should be reliably measured, and second criteria, if you're looking into IAS 16 or IAS 2, the recognition criteria is that the cost of any asset should be reliably measured, and second one is it is probable that inflow of economic benefit should run towards the entity, right? So most of the international accounting standards should follow the same criteria. Different accounting standards use different level of probabilities to discuss when assets and liabilities should be recognized in financial statement. For example, economic benefits from property, plant and equipment and intangible asset need to be probably to be recognized, to be classified as held for sale, or to be highly probable under IAS. These 3 standard, IAS 16, IAS 38, IFRS 5 should say that it's highly probable that the economic benefit flows towards the entity, while IAS 37, what it mentions for contingent liabilities and contingent assets, provision, it should mention that provision should be recorded if it is probable. A provision is a liability. It should be recognized when it's probable that the outflow of economic benefit should be done. While in the same time, IAS 37 mentioned for the asset that asset should only be recognized if it is virtually certain to that the inflow of economic benefit would arise as a result of that contingent asset or the asset you're going to recognize, right? So that's the different criteria provided by. Uncertain assets, on the other hand, would have been virtually certain. This could lead to a situation where 2 sides of the same court case, this is an example just mentioned. If a court case was held within the court, there is one party who's claiming for the damages and other party who's defending for the damage, that it's not my fault that I have to pay the damages. Another party insists on that it's the fault of the other party and I am going to claim the damages. If it's probable that entity A which is defending the claim that the entity A is probably have to pay the entity B, while the entity B for entity B, which is claiming for the damages, it's probable that entity B will be receive the damages. But entity A under IAS 37, entity A must have to recognize a liability. On the same time, at the same time, entity B, which is going to claim it, cannot recognize an asset. Irrespective, both parties have a same probability criteria. One party have to recognize it, and other party is not allowed to recognize it under IAS 37 criteria, right? So that's the different aspect, and that should be recorded. The contingent consideration is recognized in financial statement regardless of the level of probability. The contingent consideration, you might have understood under a consolidated financial statement, the contingent consideration, you have to record it. Rather, the fair value is adjusted to reflect the level of uncertainty of the contingent consideration. You have to adjust the fair value of that item to make sure that uncertainty was accounted for. Next thing is why the change in the framework, the conceptual framework, has not impacted the definitions of assets and liabilities within the accounting standard. This is, the board has confirmed a new approach to recognition criteria which requires decision to be made with reference to the qualitative characteristics of financial information. An entity should now recognize, it's under the conceptual framework, an entity should have to recognize an asset or liability if such recognition provides users of financial statement with more relevant and faithful representation of assets and liabilities and information which results in benefits exceeding the cost of information. So these are the two recognition criteria based on the fundamental qualitative characteristics. If providing any assets or liabilities within the financial statement provide more relevant and faithful representation of an asset and liability, that should be recognized. And then providing the information within the financial statements would give more benefit compared to the cost associated with that specific asset. So that's the criteria of IAS. This is the main idea of conceptual framework. A key change here is to remove the probability criterion. That's something the new framework has changed. The new framework has changed the probability criterion. This means that more assets and liabilities with the low probability of inflow or outflow of economic resources are likely to be recognized. Now, with the change in probability criterion, the more assets and liabilities can be recognized within your financial statement. The board accepts the structured prudence can still means there will be inconsistency recognition assets and liabilities within the financial reporting standard, but may be necessarily consequences of providing the most useful information for the stakeholders. The board has acknowledged that some IFRS do include a probability criterion of recognizing assets and liabilities. For example, IAS 37 provisions contingent liabilities and assets states that provision can only be recorded if there is a probable outflow of economic benefit, while IAS 38 intangible assets highlights that for development cost to be recognized, there must be a probability that economic benefit will arise from the development towards the entity. The change to the definition of assets and liabilities will leave these unaffected. The board has explained that these standards don't rely on the argument that items fail to meet the definition of assets or liabilities. Instead, these standards include probable outflows or inflows as a criterion for recognition. The board believes that this is uncertainty. The board believes that this uncertainty is the best dealt with the recognition or measurement of items rather than in the definition of assets and liabilities. So for these two standards, IAS 37 and IAS 38 for development criteria, the board has not changed the definition or not changed the recognition criteria based on those items or based on the changes in conceptual framework definition. So that's the main idea of the new conceptual framework. If anyone has any concern right now with respect to this, do let me know, and we'll be We'll be coming back with another scenario. I have already shared with you this next question that should be account. We are going to account it for the same question. It's a consolidation question, as consolidation constitute the majority of the scores, and most of the course was accounted for within these two sections. So I'll be looking into another question tomorrow with from the same section. This is question 2, and this question is actually related to consolidation. I recommend all of you to go through this question and look into the things that confuse you guys. So we'll be focusing on those items more, but I'll be looking into this question tomorrow, and we'll be answering your question with respect to this specific section. And then we're looking into the next portion, the next question of the next question section of our paper. That's the question 2, which is related to the evaluation aspect, section 1, and question 2, which is mainly related to ethical implications and reporting implication of specific events. We'll be looking into how standard was applied by the management and how the accounting standard actually explain these standards should be applied. Any question as of now, do let me know. Otherwise, yes, I looked into your questions later, and I found out that the screen was stuck. Surely that would not going to happen tomorrow. Yes, I'm actually receiving the messages. Unfortunately, that was something I missed to account for. Unfortunately, this was the pause button was clicked for the screen, and that was not resumed again. That was my mistake. Apologies once again. So tomorrow it is not going to happen tomorrow. Okay, thank you guys. If there is no further question, then we'll be okay. I know, but that's something I'll be more careful by tomorrow, that I'm not going to pause the screen. Unfortunately, I don't know when it was clicked out, so I missed it. But it will not going to happen tomorrow. Thanks all, and we'll be meeting tomorrow. Question 1C. Give me a second. Question 1C. Question 1C is related to as held for sale. So this held for sale must meet the IFRS 5 criteria. So as far as the situation of Watson or Braham was concerned, you can clearly say that for Braham, the company might have a plan to place this subsidiary as a discontinued operations well before you're going to dispose of this subsidiary. Why? Because Braham was making loss from last many years, so the management might have planned for it. So once we know the actual criteria or actual understanding of the management about the Braham, then we can place that Braham as a discontinued operation. But before placing this Braham as a discontinued operation, we must make sure that Braham is an independent unit that is capable of they're capable of generating its own cash flow. That's a criteria that was mentioned here, that discontinued operation should be. Just a minute. This must be a separate line of business, a separate major line of business, and which is very clear with the name that it is a subsidiary. As it is a subsidiary, so it must have a separate major line of business and a geographical area or an operation. So you can place Braham as a discontinued operation. While for Watson, as Watson does not appear to meet the definition of non-current asset held for sale. Why? Because you are not selling Watson. The control was actually lost. Why? Because the change in the capital in the share structure of the company. Company has issued some effective share options. If and when these options would be exercised within the next year, this subsidiary is the Watson is no more would remain the subsidiary of Moyes, the group, right? Then if the structure of the company, if the status of the company has been changed within the Moyes group, which is because of the loss of control. So based on the framework guidelines and the IFRS 10 guidelines, if the control was lost, in which you know that the controls were lost, then you can place Watson Group even as a discontinued operation, but that was not mentioned within IFRS 5 guidelines. IFRS 5 does not provide you any guideline about placing a company or a cash generating unit or a group of assets or a separate business entity as a discontinued operation if you are losing control of that specific entity. Over here, you are just losing the control. You're not disposing of any stake in Watson company. Are you getting the point? So based on this lost control, you can place even Watson as a discontinued operation, but once you are explaining it why you have placed in this specific section as a discontinued operation, you must be explaining to the stakeholders that the main reason of placing this Watson company as discontinued operation because of the lost control, right? Any other question if anyone has? This question was actually answer to these questions was already shared with you guys. I believe it's in handouts. You would be provided with these documents. You can download those documents from handouts. So the answer was already available. Thank you everyone, and surely we'll meet tomorrow. Thank you so very much.